All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world. Happy Friday, everybody. Today is July 11th, 2025. And man, this show is going to be loaded today. There is a lot going on here. A lot of things I really like to talk about are moving this morning. We got to start with my favorite of the shiny silver. Overnight front month contracts for silver futures hit a high of $38.65. We have not seen levels like this since 2011, since the last monster bull run in silver. WTF is going on? Well, if you read between the lines, you can kind of figure out what's going on. And I got to send a shout out to my friend Bob Coleman from Profits Plus ID, Idaho Armored Vaults. Bob called this move a couple of hours before it happened yesterday. He saw it coming. And the key is the difference between the spot price and that front month futures contract. The spot price at $37.72, almost $1 less than that front month contract. That is known as exchange for physical, or the EFP premium blowing out. So what is going on? Well, the spot price of metal is set in London at the London Metals Exchange. But that exchange for physical, or that front month premium, that is set on the COMEX here in New York. So we've got metal a month from now in New York worth a lot more than metal right now in London, which means we're seeing the metal flow back into the United States. Guys, this is that tariff trade that propelled the monster run in gold at the beginning of this year. It really looks like that's what's driving this, and why it's got to have something to do with that announcement of tariffs on copper that we got from President Trump just a few days ago. It appears that it has reignited the tariff trade, the tariff tantrum, whatever you want to call it, the metal drain. It has spread to silver. And you can see it also in platinum and palladium, something Bob Coleman also pointed out yesterday. Exchange for physical premiums in platinum and palladium also blowing out. Now, interestingly enough, while all this is going on, while we're seeing silver rally, platinum rally, palladium rally, gold, not so much. I mean, gold is up, but not anywhere near what the other, we'll say, lesser metals are doing. We've actually got the gold to silver ratio is now below 90. And as my friend, the Happy Hawaiian on Twitter points out quite often, the gold to silver ratio around 90 has been a pretty strong inflection point. It was some serious resistance for the start of the year as gold was rallying. It blew out. With gold to silver ratio went to like 103, 104 at one point. Now we have come back down as silver has caught up to gold, and it's continuing this morning. We're down around 88 in the gold to silver ratio. Now, while all this is going on, gold has been forming a bull flag on its chart, meaning gold is just kind of sitting here, letting the other metals play catch up. Okay, yeah, we got this copper tariff thing going on, silver, platinum, palladium run. It really looks like gold is setting up for another big leg higher once silver and platinum and palladium have run their course. And why would that be happening? Probably for some similar reasons that we're seeing this monster move in Bitcoin. Now, I get it. We got a lot of Bitcoin haters on this channel. And, well, guys, you're going to be red in the face when you see this one. The price of Bitcoin overnight hit an all-time high of $118,909 on Coinbase last night. WTF happened? Well, we mentioned yesterday on the show when we were looking at Bitcoin how we had just tickled that all-time high a day before. It was looking like a breakout and that we could be moving to 120,000 in pretty short order. And of course, I throw in my disclaimer, Bitcoin winter is coming. There is a big move down in Bitcoin on the horizon. But between here and there, there's probably another big leg up. So what's driving in Bitcoin? ETF inflows yesterday, the highest they've been all year. More than $1.2 billion flowed into ETFs yesterday. That is propelling it higher. ETFs since April have bought, I believe the number was $15 billion. Maybe it was 16. Don't quote me on that, but I have it in the article we're going to read here in a little bit. That is more Bitcoin has been bought just by ETFs since April than the entire year's worth of new Bitcoin that's going to be mined. In other words, guys, it's a simple supply and demand. Demand is way higher than supply, and you know what price does in that situation. And that's just the ETFs. We've also got all these cockamamie Bitcoin treasury companies out there. They're all trying to mimic what Michael Saylor's doing over at MicroStrategy or the artist formerly known as MicroStrategy, whatever they're doing over there. You've got these Bitcoin companies, the treasury companies, they're borrowing, they're issuing shares to buy Bitcoin. Yes, it's leverage on top of leverage. I get that. And it's eventually going to have a reckoning, but that is not today. In the meantime, this risk on in tech also propelling people into Bitcoin. You've got a FOMO rally kicked off where every time Bitcoin runs like this, people who said, well, I should have bought Bitcoin a year ago at 60,000. I'll go ahead and buy it at 118. You have that going on. Yes, unsustainable amounts of leverage building up. That all means higher Bitcoin prices. Now, what do these two stories have in common? Metals running, Bitcoin running. Underneath all of it, and all the little market mechanic functions that are going on, the ETFs and the exchange for physical premiums, you have this underlying theme of grotesque fiscal recklessness running rampant worldwide, not just here in the States, also in Europe and in Asia, and we've got some stories to that effect. And of course, the one big beautiful bill and the $5 trillion of raising of the debt ceiling, it all means we are watching dollar become less valuable. The de-dollarization is continuing too. And to that effect of de-dollarization, you've got a little bit of trade hysteria going on. Guys, the tariff noise is getting louder and louder, even though the market continues to play chicken with President Trump and his trade team. We've got 35% tariffs on Canada. That is the latest salvo in the trade war. President Trump came up with that one yesterday. Market did not like it, started heading south as soon as that came out, and it's heading south again this morning. You've also got the U.S. has agreed to sell weapons to NATO, and then NATO is going to give those weapons to Ukraine. So instead of just giving the weapons to Ukraine, now we're selling them to Ukraine. We're getting paid for them. So some of that borrowing and spending and the Zerpenberg that's going on in Europe, all that money they're going to spend on new defense, a lot of that is just going to flow right back into the United States in exchange for the weapons we've been just giving them this whole time. At least now we're getting paid for them. Of course, the U.S. is going to take that money. We're going to give them our old weapon stockpile, probably use the money to buy our new weapon stockpile, because we're certainly not going to reduce our national debt. Heck no, not when we can buy more things that go kablooey. Trump is also planning a major announcement on Russia on Monday. Your guess is as good as mine. What the heck that means, I don't know, but President Trump has expressed a lot of frustration with Vladimir Putin and the Ukrainians, for that matter, about the lack of progress in peace talks. And, well, he's about to throw a fit. So get your 2020s bingo cards ready. Who knows what that's going to mean? Meanwhile, we've got Taiwan just passed a big spending bill as well. A lot of money being spent on defense, largely viewed as a placating measure for President Trump, who has criticized the island about not taking its own defense seriously. And let's throw a little bit of helicopter money in there while they're at it. They're giving some stimmies to the people in Taiwan. You've got Red Sea insurance premiums have spiked dramatically once again, thanks to Houthi and the Blowfish, who are sinking ships and killing sailors again. And last but not least, the Saudis pumped an unusually high amount of oil last month, as did some of their neighbors in the Gulf. Why are they producing so much oil? And the world is headed to a serious supply glut in the oil market. Geopolitical tensions aside, we could be looking at sharply lower oil prices on the horizon. OMG, guys, it is a busy morning. Why don't we shrink my big melon of a head and let's see what is going on in the world of finance. And this is when I say hit that like button for the YouTube algorithm. And if you're new here, hit that subscribe button as well. And come on back on Monday, because we do this every business day. So come have your coffee with the melon heads. Right now, the S&P 500 is lower, down by about 34 points, or about a half of 1%. Those tariffs on Canada likely weighing on stocks this morning. The Dow is also down about 0.6%, 267 points to the downside, near its lows of the morning. And the NASDAQ faring a little bit better than its other indexes, down 107 points or 0.47%, but still pretty deep in the red this morning. So stocks are selling off just a little bit here. Meanwhile, the U.S. dollar is a little bit higher, 97.82. That's up by 23 basis points. Now, the U.S. dollar over the last 6 months, we went from a high of about 110 all the way down into the 96s. We've caught a little bit of a bounce here, but we have seen a dramatic weakening of the dollar this year, and I'm sure that is playing a role in the silver and the Bitcoin and the gold price movements, along with some of those other commodities, and of course, stocks as well. Looking over at the bond market, yields are up again this morning, just a little bit. The 30-year Treasury is higher by 5 basis points. I guess that's a medium bit, not a little bit. 4.914 for the 30-year Treasury. The 10-year is also up, not quite 4 basis points, 4.395 for the 10-year. The 2-year is at 3.893. That's higher by 2.5 points. And even the 1 month is higher by 1.5 points at 4.324. So we got a little bit of selling going on in bonds this morning. Looking over at the commodities board, that is where a lot of the fun is this morning, starting with spot gold, $3,356, up by 1%, 30 or about $32.50 higher. Also, the front month gold contract higher by $43 at $33.69. So you can see here, guys, the difference between the move in the front month and the move in the spot price. We're seeing a bigger move in that front month contract. That's those EFP premiums getting a little bit bigger. Now, that is not nearly as big as what's going on in silver. Look at the difference in silver. First of all, spot silver, $37.69, higher by 68 cents this morning, 1.8% higher. I like the shiny. But the big thing about silver, it's not the move in the spot. Look at that front month, that September contract here, $38.51. It hit a high overnight of $38.65, and that is higher by $1.20. Almost double the move in the front month silver contract versus what we're seeing in the spot price. Silver a month from now in New York is a lot more valuable than silver right now in London. That means that metal is going to start flowing back into the States, and that is what we saw during the tariff panic in the first quarter or the first half of this year, which is what propelled gold to these new all-time highs. It's got to have something to do with what happened in copper and those copper tariffs, which, by the way, this morning, copper, oddly enough, the one metal that's not higher. Copper is lower by 1.2%, $5.52 for September copper futures. While we're here, let's talk about the big move in platinum, higher by 3%, $14.54 for October platinum futures. Palladium also getting in on the move, higher by almost 4%, $1,244 for palladium. We've got crude oils higher by about 75 cents here, 1.1% higher, 67.33 for August WTI futures. Now, I got to send a shout out to my buddy Bob Coleman from Profits Plus ID on Twitter. If you guys are in the gold and silver space, or if you like watching metals, you must be following Bob on X. He is fantastic, frequent guest on the channel. And as soon as I wrap up this live stream, I am going to get on email with Bob and invite him to come on the channel and talk about what we're seeing right now, because that is long overdue. But he posted this one yesterday. This was at about 1 o'clock yesterday, right as this move was getting underway. He writes, silver, platinum, palladium alert. EFPs, exchange for physical spreads, are rising rapidly today. Silver EFP up 70%. Platinum 3x, palladium 2x. This may be associated with copper tariff concerns. Premiums started to rise on silver 1,000-ounce bars. And you can add this to the list of several excellent calls that Bob has made this year in this space. Because really, I mean, these moves, they were already underway when Bob made this call, but we didn't really see the big move until several hours later. So shout out to Mr. Coleman once again. Now, let's look at the silver chart here. We are looking at 1 week candles. This chart is going all the way back to about 2008. And the reason I'm pointing this out, guys, is because, well, if you're looking for like resistance, support lines, things like that, there ain't any, because we're back in, we're into this territory, in that blow off top that we saw in 2011. I mean, that's, if you're looking for your support and your resistance levels, that's where you got to look, because we just took out the level from February of 2012. We are back into numbers that we haven't seen since September of 2011. I suspect silver is probably heading to $40 here in pretty short order. It's got some catching up to do with gold still. And then, of course, gold is probably going to rip from there. Now, let's look at what the gold to silver ratio is telling us. This is the value of an ounce of gold divided by the value of an ounce of silver. And the two metals tend to exert influence on each other. If gold runs really hard, really fast, and the gold to silver ratio stretches, think of it as a rubber band, it's going to pull silver higher. Just like if the price of silver crashes, but gold isn't, that rubber band can exert a little pressure. Maybe gold can pull silver back up, or maybe silver can pull gold down with it. The two prices exert a force on one another. It doesn't necessarily mean a price will move in one direction or the other, but the gaps tend to close. Now, we saw the gold to silver ratio. Let's set this up so that we're going back to about the middle of 2024. This level I have here shown in this red horizontal line right around 90. You can see several times we got to this level, and it was kind of acting like resistance all through the beginning of this year. The gold to silver ratio, we didn't want to go much above 90. Of course, then after April, when silver went on that, or when gold went on that monster run following the tariff hysteria, we saw the gold to silver ratio blew out. All right, we saw silver sell off a little bit along with the other metals, or along with other risk assets during the tariff hysteria. The GSR went as high as 105. Ever since then, silver has rallied while gold traded sideways, so the gold to silver ratio has been coming down. Now, we broke below that 90 threshold yesterday. So what does that mean? Does that mean maybe silver's price could collapse here, which would send the gold to silver ratio back into this territory a lot higher? Or maybe this means silver keeps running. And, let's zoom out on the chart here, guys, because historically, the gold to silver ratio has lived way below its current threshold. I mean, down closer to about, honestly, over the course of my lifetime, the average gold to silver ratio has actually been closer to about 65. So if we go to something like, closer to the historical average, well, that means silver could have a lot of room to run here. Now, besides the gold to silver ratio, take a look at the chart of gold. Now, this is daily candles going back to the beginning of last year. Gold has had just a phenomenal couple of months here. But I just want to point out this pattern here, guys. This looks like a bull flag pattern being put in, which would mean gold could be poised for another big move higher. Even as all this gold to silver ratio stuff is happening and the other metals are outperforming, maybe that spring is just recoiling and we could see another move higher in gold. Now, look at what central banks are doing, lowering interest rates around the world while governments spend like crazy. It's obvious the return of Zerpenber is on the horizon, so it's reasonable to expect gold to move higher. Guys, I've said it several times over the course of the last few weeks. We just don't own enough gold for what's coming. And that's why I like the shiny. Now look at Bitcoin. Same thing happening with Bitcoin. These are daily candles on the Bitcoin chart. We are down off our highs here. We hit a high overnight of 118,909. We're down off those highs here, 117,654, still up by about $7,000 from where we were this point yesterday morning. Now, let's talk about some of the market mechanics happening in Bitcoin. This article in CNBC is pretty good here. Bitcoin flies to new all-time highs, topping $118,000 as institutions pile into ETFs. Bitcoin extended its rally on Friday, rising to new records overnight after Bitcoin ETFs saw their biggest day of inflows of the year. The price of the flagship currency was last higher by 4% at 118,000. Okay, let's move past this. On Thursday, Bitcoin ETFs logged their biggest day of inflows of 2025 at $1.18 billion. And that doesn't do it justice, guys. Since April, Bitcoin ETFs have added more than $15 billion. That is almost an entire year's worth of Bitcoin mining supply. There's only 450 new Bitcoins a day mined right now. And when $1.2 billion gets dumped into ETFs, that means there's a lot of new buying. There are a lot more new buying than there is new supply. It's going to take your prices higher. They go on to talk about Ethereum. Ethereum is running as well here. I don't really get as excited about Ethereum, even though I own some that I mined a few years ago, but I don't really trade that. The rally began more slowly on Wednesday following the release of the minutes of the latest Federal Reserve meeting, which showed a divergence among officials about how aggressively they would be willing to cut interest rates. Bitcoin, also helped by a rally in tech stocks, ran up into the close, reaching its first new record since May of 22. Now they're saying here that, or since May 22nd, not May of 22. So they're saying the general risk-on sentiment in markets may be what's propelling Bitcoin here. Probably a little bit of that going on. We've got NVIDIA's now a $4 trillion market cap. Gag me. People just can't get enough tech stocks. Number go up. That's going to spill over into Bitcoin and crypto. That's when we started to really take out the top range, said Marcus Thielen, CEO of 10X Research. It's expected that whoever comes in to lead the Fed next is going to be dovish. We also know that saving the budget deficit has sort of been pushed under the rug, he added, nodding that the One Big Beautiful Bill Act, which is expected to increase the federal deficit and which can be a positive catalyst for Bitcoin. So you say, look, fiscal recklessness, dovish central banks, that means gold, silver, and Bitcoin higher. Fed independence has been a theme for institutions going back to about April 17th. That's when inflows into Bitcoin ETFs ramped up and when President Trump hinted that the termination of Federal Reserve Chair Jerome Powell could be necessary given the central bank's stance on interest rates. Since then, inflows have grown to nearly $16 billion. There's the number. I said 15 earlier. Couldn't remember if it was 16 or not. So they're saying worries about Fed independence. Maybe that's contributing to the run in Bitcoin. You can time this move to when Trump's arguments with Powell this time around started. Look, either way, regardless of Fed independence, the Fed's going to print again. Whether you still have Jerome Powell in there or whether we put some Trump minion in there, it doesn't matter. We talked about the Kevins yesterday. Either way, they're going to Zerpenberg, guys. It is inevitable. They have shown us time and time again that the second things get hard, that's what they'll do. And Bitcoin can see that. This week's move higher triggered by a big wave of short liquidation. So you also got a little bit of a squeeze going on in Bitcoin. In the past 24 hours, Bitcoin has seen more than $650 million in short liquidations, and Ether more than $215 million. They keep trying to tie Ethereum here. When traders use leverage to short Bitcoin and the cryptocurrency's price rises, they buy Bitcoin back from the market to close their positions, which pushes the price up and causes more positions to be liquidated. That is a textbook short squeeze. For the week, Bitcoin is on track for nearly 10% gains, while Ether is up more than 20%. There they go mentioning Ethereum again. It's almost like there's a little bit of an agenda there, but I digress. All right, so that's your move in Bitcoin. That's your move in silver. Geopolitically, we got another mess on our hands this morning. Trump escalates Canada trade fight with 35% tariff threat. And I think this move in silver, like we talked about, the copper tariffs probably played a role. And guys, this market is playing chicken with another tariff freakout in the bond market here. So pay attention to this, especially you Uber bulls. President Donald Trump threatened a 35% tariff on some Canadian goods and raised the prospect of increasing levies on other countries, ramping up his trade rhetoric and comments that weighed on stocks and boosted the U.S. dollar. The tariff level on Canada would take effect from August 1st, the president said. This announced rate is an increase from the current 25% tariff that's imposed on U.S. imports from Canada that aren't shipped under the terms of the USMCA, U.S.-Mexico-Canada agreement. The 35% levy mentioned by Trump currently doesn't apply to the goods that are traded under the rules of the USMCA, and the exclusion is poised to remain in place, according to an official who, of course, requested anonymity. The U.S. is also expected to keep a lower 10% tariff on some energy-related imports, the official said. The move would not affect higher levies on key materials such as steel and aluminum, which are under a different tariff regime. The situation remains fluid, and the legal order has not yet been drafted, they caution. Trump tariff plans are unpredictable and often revised, including immediately prior to a deadline. The term elsewhere in the article said Trump's tariff policies have been known to vacillate from time to time. So who had vacillating tariffs on their 2020s bingo? Look, are these tariffs on Canada going to happen? I don't know. Is the taco trade going to come back? I don't know. Maybe, probably. But there is a non-zero chance that the taco trade doesn't come back. And if the taco trade doesn't come back, if Trump decides, no, F it, I'm going through with this, then this entire freaking market is way off sides. I'm not saying that's going to happen, but let's be honest, guys. It could, it might, probably not, but it might. Meanwhile, Trump says U.S. to supply weapons to Ukraine via NATO. All that extra spending on European defense stocks, some of it is coming here. U.S. President Donald Trump said on Thursday the United States would supply weapons to Ukraine via NATO and that he would make a major statement on Russia on Monday. We don't know what that major statement is going to be. I guess we're just going to have to wait. In recent days, Trump has expressed frustration with Russian President Vladimir Putin over the lack of progress towards ending the war sparked by Russia's full-scale invasion of Ukraine in February of 2022. I think I'll have a major statement to make on Russia on Monday, Trump told NBC News, declining to elaborate. Trump also told NBC News that what he called the New Deal between the U.S. and NATO allies in Ukraine over weapon shipments from the United States. We're sending weapons to NATO, and NATO is paying for those weapons 100%. So what we're doing is the weapons that are going out to NATO, and then NATO is going to be giving those weapons to Ukraine, and NATO is paying for those weapons, Trump said. We send weapons to NATO. NATO is going to reimburse the full cost of those weapons. So look, that's the difference, guys. NATO's going to pay. Now, Trump's team will identify arms from U.S. stockpiles to send to Ukraine under presidential drawdown authority, which allows the president to draw from weapon stocks to help allies in an emergency, the sources said, with one saying they could be worth about $300 million. Trump on Tuesday said the U.S. would send more weapons to Ukraine to help the country defend itself against intensifying Russian advances. The package could include defensive Patriot missiles. We've seen several mentions of Patriot batteries in the last few weeks, but also it could mention offensive medium-range rockets, but a decision on the exact equipment has not been made, the sources said. One of the people said that this would happen at a meeting on Thursday. So, look, Trump is pissed at Putin. The peace talks are going nowhere. He's very transactional. Mish and I were talking about this morning on our morning phone call. This is one of the most transactional administrations we have ever had. Love him or hate him, you have to admit everything is like, you give me this, I give you that. Everything is a trade. Whether it's political, financial, or weapons, it's a trade. There is no donating here. So this is pretty interesting to see. We'll see what kind of weapons they give the Ukrainians. If we start giving the Ukrainians more long-range offensive missiles like those ATACMS missiles, that means he is very pissed at Putin and talks are not going well. If he only gives defensive batteries, things like Patriots, maybe that means they're still at the table and they're still talking with the Russians. So depending on what they send them, you can draw some conclusions from that. Now, as Europe and NATO and the U.S. invest in things that go kablooey, maybe the word invest isn't the right word. Maybe, as you could say, we burn money on things that go kablooey. Taiwan is doing the same thing. Taiwan passes a bill to fund defense spending, $340 cash handouts, helicopter money, and bombs and missiles for everybody. Taiwan's opposition lawmakers forced through a special bill that provides billions of dollars of new funding for the military in a bid to placate the Trump administration, which has urged Taipei to do more to defend itself from an increasingly assertive China. The legislature on Friday approved a $545 billion new Taiwan dollar package. That's about $18.6 billion US. After weeks of political wrangling, the opposition bill includes $150 billion new Taiwan dollars to strengthen defense capabilities, including investments in communication satellites and surveillance and reconnaissance equipment. The wide-ranging proposal also provides funding to boost the economy and cash handouts of 10,000 new Taiwan dollars to each member of the public. That's about $350 US. Hey, helicopter money in Taiwan. Why not? And then we can all wonder, why are precious metals and Bitcoin rallying? The government can fund the special budget either from its fiscal surplus or by issuing bonds. So, look, the fiscal situation in Taiwan is not as grotesquely reckless as it is here in the United States and Europe and places like Japan. But still, you got more spending. You got helicopter money. You got more war spending. Guys, this all is deflation or inflationary. It's all being spent, printed, borrowed. And, of course, gold, silver, Bitcoin's going to rally when that happens. These things are related. Meanwhile, Red Sea insurance premium spikes as the Houthi risks return. Unfortunately, they're at it again. The cost of insuring commercial ships that sail past Yemen's Houthi militants surged after the rebels sank 2 ships and killed sailors this week, underscoring how the attacks have revived risks in the crucial waterway. Ship owners now have to pay about 1% of a ship's value if they want to pass through the Red Sea, said Marcus Baker, global head of marine cargo and logistics at Marsh McLennan. The world's largest insurance broker. Sorry, Marsh McLennan, the world's largest insurance broker. That premium is up from 0.2 to 0.3% in recent months. So we're talking a 3x to 5x increase in insurance premiums to sail the Red Sea. That is a massive attack, and this all happened in basically since the end of that brief period of lulls in the attacks. The rapidly rising war risk rates, which had come from lower levels during a lull in attacks in recent months, reflects underwriters' concern that the dangers on the route that links Europe with Asia have now returned to levels last seen about a year ago. Now, there's one thing I want to point out here, guys. They're talking about the dangers of the route that links Europe with Asia. Do you know what that route doesn't link? The United States to freaking anybody. So, might I throw this out there, that it is not worth it for the United States to spend lives, money, missiles, things we cannot replace to defend trade between Europe and Asia, especially not when we are in a trade war with Europe and Asia. Make the math make sense. Why would we send ships back and put our sailors' lives in danger to protect cheap Chinese consumer crap bound for Europe? That sounds more of a them problem than an us problem. We can say, you know what, our ships don't really use that waterway as much. We'll sail around. Doesn't really matter. It's very much more of a them problem. But I digress. Last one of the day, Saudis lift oil output above quota in a rare OPEC plus breach. This story's kind of crazy, not so much for the fact that the Saudis lifted the output, because it makes sense why they did it, but there's some numbers hiding in the middle of this article that are pretty interesting. Saudi Arabia raised crude output far above its OPEC plus quota last month, joining other producers in a rush to export oil out of the Persian Gulf as Israel went to war with Iran, according to the International Energy Agency. The kingdom raised crude production by roughly 700,000 barrels a day to 9.8 million barrels a day, with about 70% of the additional supply exported. The IEA said in its monthly report, it was a rare breach of agreed OPEC plus limits by Riyadh, which has repeatedly scolded other members for overproduction. Iraq, Kuwait, and the UAE also raised production and exceeded their OPEC quotas, the IEA said. Iran's production, meanwhile, declined by 400,000 barrels a day in June from a 7-year high to 3.08 million barrels a day, though the country's oil infrastructure was largely unaffected by the hostilities. So you had Saudi Arabia, Iraq, Kuwait, and the UAE all shipped way more than their share of the OPEC quota. Why? Because they were worried about the Iranians closing the Strait of Hormuz, which ended up not happening, by the way. But it just goes to show you they were dumping oil on the market. Get it out as soon as they can before it gets stuck in the Gulf. The flood of extra crude comes as global oil markets head for a substantial surplus. World oil consumption will grow by about 700,000 barrels a day this year. That's the slowest pace in 16 years, excluding the 2020 pandemic slump. It's a modest downgrade from the previous month. Production from outside of the OPEC plus cartel will grow twice as fast as global demand as the U.S., Guyana, Brazil, and Canada continue to boom, according to Paris-based IEA, which advises major economies on energy policy. And it is that last paragraph. Man, that is not good for oil prices. Non-OPEC production, U.S., Guyana, Brazil, and Canada, are all increasing production at double the rate global demand is growing, which means if OPEC keeps producing or keeps increasing production, you're going to have lower oil prices. Now, we dodged a bullet in the oil markets with that Israeli-Iranian war, and that they didn't shut down the Strait of Hormuz, which could have sent oil sharply higher. But outside of a geopolitical risk like that, oil is heading sharply lower if those supply-demand dynamics continue. And I just want to say thank you very much to the snowman. You want to build a snowman? Huh? Happy weekend, Jack, he says. Thank you so much, snowman. Appreciate the good vibes. A happy weekend to you as well, sir. Stay frosty. Also, Robert feeds the machine. He says this economy is a Kafka-esque nightmare. Kafka. I'm not familiar with the term. All I want is healthcare, but what I get is affordable AI girlfriends and SpaceX NFTs. Yeah. Sorry, we can't help you. You can't afford to go to the doctor, but help yourself to some imaginary shares of SpaceX and OpenAI, and take your chatbot girl out for a nice dinner. Don't worry, she's a cheap date. She doesn't eat much. Yeah, I tell you, man, that you kind of hinted at something I was ranting about yesterday. All our economy produces is altcoins, shit coins, and Ponzi schemes. We can't build ships. We can't build rare earth magnets. We can't mine for anything. We certainly can't build a pipeline. Oh my God, the Gretas will just come out of the woodwork. But you know what? We can innovate financial fraud like no other. Yep, that is the economy we have, Robert. Thank you, sir, for supporting the channel. Uncle Fedster says, happy Friday, Jack. I bought my first 4 ounces of platinum for my precious metals IRA right at 1 year ago for some diversity. Long-term outlook. All right, so long-term outlook for platinum. I'm very critical of electric vehicles, but I do think electric vehicles will continue to take market share from internal combustion. You're going to have ups and downs along the way. Right now, we're in a big down. All right, ICE engines are making a comeback versus electric vehicles. even as the world continues to produce more electric vehicles. So I do think over time, as electrification technology improves and hopefully someday the power grid problems get solved, I think we'll see EVs continue to capture market share. That's very bearish for platinum long term. Geopolitically, platinum, it comes from countries that are not our friends. BRICS controls almost all of the global platinum supply. All right, so that could be very uber bullish for U.S. platinum prices in the long term. And that's really the big thing with the platinum market, right? You got the gold to platinum ratio. It's been declining for decades. It's been rising for decades as gold has vastly outperformed platinum. And then it just like fell off a cliff over the last few months. So you've got your auto sector and your geopolitical risk. Those are your two big factors in the platinum market. Now, I have a little bit of exposure to platinum in an ETF. I don't own any physical platinum, and there's a reason for that. Be careful when stacking physical platinum, and I've actually seen some stacking channels make this mistake, all right? I like the shiny. Here's my silver bar, all right? This silver bar, let's say I get hit by a truck tomorrow, and my girls go to liquidate my holdings. This could be platinum, and they would not know the difference, and they could go sell it, and they could accidentally sell a 10-ounce bar of platinum for the price of a 10-ounce bar of silver, and nobody would be the wiser except the guy who bought it and walked away with thousands of dollars in free gains. So if you are going to stack physical platinum, take steps to make sure someone who isn't you knows that is more valuable than silver in the event of your untimely demise. That is an unusual risk with platinum, and that's one of the reasons why I don't stack physical platinum. It's just too easy for somebody to make that mistake. Plus, I don't think platinum really gets you anything that some combination of gold and silver doesn't also get you. If you want industrial demand, you can get that price exposure in silver. The only thing is platinum, it's a little bit more efficient. It doesn't take up as much room as silver, so that's something you could think about. But that's my general take on stacking platinum. Thank you, Uncle Fedster, for supporting the channel. Chuck G says, should I start buying U.S. defense stocks now that the U.S. is selling weapons to Europe? Look, defense stocks in general, not a bad idea. If you're going to buy a U.S. or a European defense stock right now, I would say probably the Europeans are the better play, at least for the next few years, although a lot of that baked in. The European defense stocks have had an excellent year. But here's the thing. The Europeans, the defense stocks are getting investments in things right now, but they're not going to be able to spin up production in time to make a lot of that money. And, you know, what's happening right now, especially with the story about NATO buying weapons from the U.S. to give to Ukraine. Look, the other NATO countries would like nothing more than to give the middle finger to Donald Trump and to make their own Rheinmetall missiles or you know, the European contractors send their missiles to Ukraine. But they can't make them. They don't have them. They have no choice but to buy weapons from the U.S. So, in viewed through that light, U.S. defense stocks, probably a good investment. Also, the big, beautiful bill just made a whole bunch of spending for defense capabilities possible. I mean, we just saw yesterday the DoD bought 15% of the shares of a precious or a rare earths mining company. Defense spending is on the rise, so defense stocks probably a good bet for the foreseeable future. Charles, thank you, sir, for supporting the channel. Zeeble Fritz says, while everyone watches precious metals, don't sleep on uranium. You know, I got to send a shout out to my buddy Dan Hedin from my Patreon group, who mentioned on our Zoom call a couple of weeks ago that the President Trump fired the head of the NRC, or the former chairman of the NRC, Chris Hansen. And then there was some back and forth about whether or not he would be able to do it. But that Supreme Court ruling from a couple of months ago, when they ruled that President Trump can fire independent regulators, everybody but the Fed. You may recall when that ruling came out, I said, you know who they didn't exempt from that besides the Fed? They didn't exempt the NRC. I said that was a very big deal. A few weeks later, they fire an NRC commissioner. So there has been a big move towards less stringent regulation in the nuclear industry in just the last few weeks. You better believe that's going to be bullish for uranium. Now, there are still massive regulatory hurdles that need to be overcome for the nuclear industry, but they got a little less massive, or I should say they got a lot less massive when they fired that commissioner. So I agree, uranium, probably pretty good. Now, uranium has made a wild move in the last year or so. It's come back down to earth a little bit, but I think the world's movement back towards nuclear will continue for several years. And I am excited about SMR technology. I hope we continue to develop it. I think it's a no-brainer from a technology and a national security and economic security standpoint. Just be careful in the nuclear space. Anytime you get a big, surge of enthusiasm, the hucksters come out of the woodwork and they start selling the snake oil. Nuclear is no different. There are a lot of snake oil salesmen to watch out for in that space. Thank you, Zeeble Fritz, for supporting the channel, sir. Nashville Pasta Man says, unspoken truth of benchmark currency. They let us print like spoiled children and we fight their wars. The sooner the currency crashes, no more wars. President Trump said yesterday, it's funny you should mention, very timely statement there, Pasta Man. President Trump said yesterday that a loss of world reserve currency status would be akin to losing a world war, is what President Trump said yesterday. So quiet part out loud, he's saying we will go to war to defend the dollar as the world's reserve currency. That's kind of what he said. And if you notice, who are some of the countries that Trump has very aggressively tariffed recently? South Africa and Brazil. And yeah, China's really ultimately been the target. But he's going after the other BRICS countries. He's trying to isolate China to try to prevent BRICS from dethroning the dollar as the world's reserve currency. And don't forget about Bitcoin. I know we got a lot of Bitcoin haters, guys. But one of the big problems that the BRICS countries have had, like Russia and India were trading oil. When we sanctioned Russia, India started buying their oil for cheap. India was paying in rupees. And then next thing you know, Russia has this huge stockpile of rupees. And they're like, what the hell am I going to do with all these rupees? If I sell them on the open market, it's going to crash the rupee. I'm going to light my own money on fire. I don't import anything from India. So what do I do with all these rupees? Hey, India, I want you to buy our oil in rubles. And India said, no, F you, we're not going to do that. So the BRICS countries need some other medium of exchange, and it's not their local currencies. The trade imbalance is too much to have that. You know what fixes this? I'm going to get a lot of eye rolls for this. Bitcoin fixes this. You can instantly move back and forth between your native currency and Bitcoin. You can buy your oil in Bitcoin, and then whoever you buy it from can move right back to their native currency in that Bitcoin as well. And you're probably sitting there saying to yourself, oh, no, Bitcoin is too volatile. It doesn't work that way. Nobody would pay for oil in a currency that could crash 20%. You can very easily hedge your exposure to Bitcoin's volatility by taking a corresponding short in the many derivative markets that have sprung up around Bitcoin. You can short ETF shares. Heck, you can buy puts in freaking MicroStrategy to minimize your exposure to Bitcoin while you're waiting for your oil trades to clear. And, hey, while this tariff tantrum is going on, while the world is moving towards de-dollarizing, we're watching Bitcoin make new all-time highs. I've said this a few times here. There is no candidate to replace the dollar as the world reserve currency. Nothing comes close. The only thing that comes anywhere near coming close, and it's still a far cry from close, is Bitcoin. Bitcoin is the only actual threat to dethroning the dollar as the world reserve currency. It ain't the yuan. It ain't the ruble. It ain't the BRICS gold-backed currency. Totalitarian governments do not give away their power by pegging their currency to gold. They just won't do it. Bitcoin's the only thing. It might happen. It might not, but it's out there. Thank you very much, Pasta Man, for supporting the channel, sir. And thank you, everybody, for having your coffee with the Melonheads. Shout out to my magnanimous Melonheads on Patreon and YouTube. Guys, there was a lot of stories I had to cut this morning because there was so much news going on. I know we ran a little long. We're going to cover those on the Zoom call this afternoon. Some big stories in the auto space. So shout out to my magnanimous Melonheads on YouTube and Patreon. Links down below should you feel so inclined. Don't forget that like button and that subscribe button on the way out. Hi, Mom. Hi, Dad. I love you guys. Till next time, live small and dream big.